Is quantitative easing finally about to end? That is an interesting question that we'll be exploring with Gary Wagner, editor of thegoldforecast.com. Gary, welcome back.
Thank you so much for having me.
Gary, you highlighted the FOMC's meeting minutes in yesterday's commentary that you submitted to Kitco. Tell us about the Fed's plan to taper.
Well, what we found very interesting was the fact that on the last FOMC meeting, they started to talking about tapering. They were a little bit more specific in the minutes because what they are saying is they want to eliminate about $40 billion monthly from mortgage-backed securities. And to me, that makes sense. The housing market right now is overheated. Homes are going for record pricing. So the fact that we're supporting that doesn't make a lot of sense. On the other hand, to continue to buy U.S. debt instruments is needed to provide liquidity to the market. So the fact that they made mention of that, to me, actually made some sense.
Do they make mention of when they would begin tapering?
Well, you know, they promised transparency, but transparency is coming through a frosted glass, so to speak. The way I look at it is the estimates are sometime early next year. I've heard anywhere between the beginning of the year and March, but only the Fed knows for sure. I would imagine that they will start tapering the mortgage-backed securities fairly soon, but I don't believe that will occur this year.
Well, they're certainly not going to make it easy for economists and forecasters like yourself. That would just be unfair.
Correct. We'd actually get it right for a change.
Yeah. You get it right more times than not, Gary. And we're going to be talking about your methodology towards the end of this interview. But first, let's go back to the Fed's meeting minutes. Now, one thing I've noticed was that the markets didn't react as, I guess, violently as one would presume. Remember back in 2013, we had a taper tantrum. So,
Yes.
This announcement, although of course they didn't announce exactly when they start doing it, it was a pretty strong hint. Yet we didn't see a major sell-off. Why is that?
Well, one thing is, if you recall back in 2013, they did not call it tapering. They called it Operation Twist, in which they were buying certain debt instruments and selling other debt instruments of different lengths in time. I think that was QE3. So we had already had a couple of rounds of really effective stimulus, and the fact that they began to wind down as the economy picked up made some sense. In this case, I think it's a little bit different. We are dealing with a completely different scenario. Yes, we have a deep recession. Yes, it is a global recession. But at the same time, the primary underlying cause, which is the pandemic and COVID-19, has now got this Delta variant. So even though we thought we put a handle on it, it seems to continue to creep within the global population. And so for that reason, although I'd like to think we're out of the woods, I still think that we are at the end of the tunnel, but we don't see the light yet.
We don't see the light yet. Why is that?
Well, I think because we're unsure of how long COVID-19 will linger. Will it linger for years to come? Will the variants continue to get worse? The new Delta variant is much more contagious. The first one was terrible because you were asymptomatic for 2 weeks, but yet you could transmit the disease. This new one is threefold as powerful as that in terms of it being contagious. Also, it is worse in terms of the symptomatic approach. In other words, how many people go to the hospital. The good news is it seems as though the Moderna and the Pfizer vaccine provides a good amount of help. In other words, there was a case in Hawaii where someone went to Las Vegas, came back, tested positive for the Delta variant, but he only had mild symptoms and he was immunized.
Okay. Well, speaking of the pandemic, how are things over in Hawaii? It's a hot tourist spot, so I like to use Hawaii as a proxy. Have things opened up?
Absolutely. We've got over 35,000 people coming in daily. You can see the planes landing every 3 minutes. I was in Waikiki, which is the mainstay for the tourists, this weekend, and it was packed again. It was unlike anything I've seen in a year and a half. What I do miss is the fact that the roads are no longer empty, but it's well worth it because we're putting people back to work. And it has been the service sector that was hardest hit, and all of the ancillary companies that feed the different people in the hotels and all of the businesses that work off of tourism. So we are seeing it come back. We're seeing it come back strong. And the key to Hawaii is you're still in the United States, so there's no problems in terms of traveling. And most importantly, it's one of the most popular tourist destinations in the world.
Well, the TSA throughput data continues to show signs of improvement. And I'll give you a personal anecdote, Gary. I was at the airport in Montreal, because I'm filming out of Vancouver right now. I was at the airport in Montreal, and I saw people there for the first time in a very long time. I used to rent cars out of the airport a couple months ago, and there was nobody. It was like a ghost town. And now there seems to be significant amount of passengers. So it does seem to me like the economy is opening up at a rapid pace. However, stocks are looking. How do you feel about equities? Do you think stocks should be reflecting this positive growth in the economy?
Well, without a doubt, they are frosty. They are frosty because individual investors are forward thinking, and they believe that 3, 6, 9 months down the road, we will get not a full recovery, but a very, very strong recovery. And so they're not betting on how they believe these businesses are doing today, although there are some companies that have done exceedingly well, like Amazon, that have made fortunes during the pandemic. But the key is this: whenever you look at how the stock market is moving, it is an anticipation on where it's going to go, not where it is. And for that reason, I feel that there is a grain of truth to what is being conveyed in terms of higher stocks, but they continue to go to all-time record highs. And that's why I believe it's frosty right now, a little bit overheated.
Okay. And the 10-year yield continues to fall. Is that due to Fed news that they potentially might be tapering anytime soon?
It certainly could be, but realize that what they're tapering are mortgage-backed securities. They are not tapering one dime off of their allocation of U.S. debt instruments. So I would have to say there's a disconnect there. I think that it was overdone when it shot up and went to 1.6, 1.56. Now it's we're at 1.3%. And so I think it's kind of the knee-jerk reaction, and then the point in time when it levels out once again.
And how did gold react on the news, Gary? Yields dropped. Suppose gold and the yields have an inverse relationship. You should see the yellow metal rise.
And in fact, we did, considering that 6 trading days ago, we saw gold around 1760, and then it broke above 1800 yesterday, went to an intraday high of 1815 in the futures market. However, it couldn't hold on to it. Now it's teetering right at 1800. To me, what we witnessed was a false breakout. In other words, it appeared as though the market really wanted to move, but when it got to a certain point, and that key psychological level of 1800 is important, that to me is when sellers entered the market or long players covered their positions.
Okay. Can we take a look at the gold chart that you have on your screen? We can go through some technicals, Gary, and we can walk through some key levels of support and resistance that you'd like us to focus on.
Well, the first thing that we do have to talk about is that the 50-day moving average has been coming closer and closer to the 200-day. Now, as the market was moving down during the correction, it appeared as though we could actually get a death cross. However, the recent uptick from 1760 up to about 1800 kind of reversed that. And yesterday, for the first time, we were able to identify a golden cross in the purest form, meaning the 50 crosses above the 200. Now, we've seen many occasions where it will cross above, then back below. It oscillates. And so we haven't been able with any kind of real certainty to say that this is a pure death cross where we will see these two moving averages begin to widen. And that is going to be the key.
Okay. Now, can you expect, let's take a look at the US dollar chart now. Can you expect continuous movement of the US dollar in the upward fashion that we're seeing now due to Fed action?
Well, when you consider that yields have gone down tremendously, that is going to put bearish pressure on the dollar, one. Secondly, the dollar's been exceedingly strong, and markets do not go straight up or straight down. They tend to stair step up and stair step down. I think what we're witnessing right now is after such a protracted and really significant move, because in a period of about a week and a half, we had approximately a 2% gain in the dollar index as it's weighted against a basket of currencies. Now, the year-to-date total is about 2.2 to 2.3%. So the entire move of the dollar occurred in an extremely short window, an extremely short time. Mm-hmm. So for that reason, I would expect periods of price decline in the dollar, but overall, I think it's going to get stronger as we get closer to rates being ratcheted higher and actually beginning to taper the national debt purchases that they're, the 10-year notes, the 30 and whatnot. That is going to really move the dollar higher because it has a yield.
Okay. Now let's take a look at, just keep that dollar chart up for a second here. I'm noticing that it peaked around April, which coincides with the peak in the 10-year yield around April as well, late April. However, now I'm seeing a bit of a disconnect. While yields have, or the 10-year specifically, has continued to fall since its high in April, the dollar has rebounded ever since June. Why is that? Why are we seeing this disconnect?
I personally believe that the dollar lags behind yields as they change. In other words, it's not an immediate reaction. If yields go lower, you'll get that reaction, but it might come a day or 2 days later as market participants see if this is going to be sustained or a very temporary move in the new yield.
Gary, we promised the audience we would talk about your methodology, but before that, price targets for gold. What are you eyeing for next week?
Well, we have to close above 1,800 effectively. If we are able to do that, my next target is 1820 and then 1847. On the side of support, we've had the recent low at 1760, and that to me is an important point. We also want to look at the moving averages because the 100-day moving average is an important number that we need to see breached.
Okay, excellent. All right, and now let's talk about how you read charts. And of course, you were telling me offline, this ties into your home decor. Funnily enough, you've got swords in the back. Is that because you're a fan of Kill Bill or Japanese culture, or is that because you want to represent visually your charting methodologies? Tell us about your background here.
Yeah, first of all, I'm a pacifist, so it's not about Kill Bill. But I started as a commodity broker in 1983. And by 1984, I realized that the vast majority of futures traders, first-time traders, lost money, about 90% of them. And I realized that if I couldn't formulate an effective technique to make money for my clients, it wasn't the proper vocation for me. And I had a client, and he won't mind me mentioning his name. It's David Moore. He is an engineer for General Electric. This was back when it was strong. And I saw him hit 10 trades in a row, but not only hit them correctly, oil would go up to like 132. He called me up, tell me to short it, and everybody was massively long. And I asked him one day, how do you have the ability to call these tops, call these bottoms precisely at the moment they pivot? And he said, well, Gary, I really can't explain it to you, but I'll send you a book. He sent me a book by Seiko Shimizu called The Japanese Chart of Charts. It was the first Japanese trader to translate that technique into English. That happened, I believe, in 1986. By 1990, you saw all of the charting services have candlesticks, but no one knew how to decipher or interpret them, what they meant. So I spent years studying them, became deeply ingrained in the methodology of the Japanese trader, because there are key distinctions between the way a Western technician looks at the market and an Eastern technician looks at the market. Because if I was to say to you that gold closed up $25, you infer that I'm referencing this close to yesterday's close. That's the most important aspect of numbers within the Western trader. Japanese don't look at it that way. They look at where the market opens during a trading session and closes during a trading session, believing that that's where the war is fought and the outcome is the certain type of candlestick. I became fascinated with the way Japanese look at the markets, their techniques of technical analysis, and I became deeply ingrained within the culture. Therefore, the swords in the background, the Buddhas in the background, and various Asian themes. It's not because I believe I'm the next Kill Bill.
Thank you so much, Gary, and we'll follow up with you next time. Where can people, first and foremost, where can people learn more about your work? And second, why exactly samurai swords then? How does that tie into the Japanese candlestick culture?
Well, first of all, the gentleman that created the candlestick methodology, first, his family owned the largest plantations of rice. They were owners in the Dojima Rice Exchange, the earliest futures exchange in the 1600s. The key was, it is said that he hit 100 consecutive correct trades. So the emperor made him an honorary samurai. And so that's where that all kind of fits in.
And your work, Gary, where can we learn more about you?
Well, I have a book called Trading Applications of Japanese Candlesticks. You can get it through Amazon. However, I highly recommend Steve Nissan's first book as a primer. And for those who are a little bit more, want to be a little bit more challenged, get Seiko Shimuzi's The Japanese Chart of Charts. It's a difficult read. It took me 3 times to understand it. But once you get it, you will gain insight that will allow you to think like a Japanese trader. Because what's important to me is the linguistics behind the way Japanese speak and write with kanji. And what it is they create word pictures rather than lines on a chart. To them, they represent pictures. And that's what makes their technique so unique and so visual.
And has the emperor made you an honorary samurai yet?
He doesn't know my name yet.
You will. Once you hit 100 consecutive right trades, you'll let us know, and then he will.
Hey, when I do that, I'll be in the Bahamas anyways. He won't know where
All right. Excellent. Thank you so much, Gary, for coming on the show today. I look forward to speaking with you next time.
Likewise. Have a great day.
And thank you for watching Kitco News. I'm David Lin. Stay tuned for more. Don't forget to subscribe on YouTube and follow me on Twitter at DavidLin_TV.